the tax burden isn't just about the level of tax, it's also about the complexity and the uncertainty around those taxes. So the national insurance has been up, down, as have various types of business taxes over the last few years. And the politicians making promises on one tax that they then break, or constrains their ability to do other things. So there's an awful lot of uncertainty about fiscal policy and tax in particular at the moment, which is very unhelpful, particularly for businesses, given the uncertainty that creates for their decisions.
Chancellor Jeremy Hunt claimed this week to reject big government, high spending and high tax in the autumn statement. He announced the permanent introduction of the full expensing to boost business investment, a cut to national insurance that will put £450 back into the pockets of the average worker. And yet the Office of Budget Responsibility Analysis reveals that the tax burden is still set to increase to the highest in 70 years, while significant new commitments were made in respect to pensions and benefits. Welcome back to the IEA podcast. My name is Lesh, and I'm the IEA's Director of Public Policy and Communications. Each week, this podcast asks a tantalizing policy question. Today's question: does the autumn statement end big government? To discuss, I'm very excited to be joined by the IEA's own Julian Jessop. Julian is an independent economist as well as an economics fellow here at the IEA. He's a prolific writer and contributor on the state of the economy, public finances, and monetary economics, and he's former chief economist here at the IEA. Welcome back to the podcast, Julian.
Thank you. Good to see you again.
What are your top line takeaways from the autumn statement? What did you make of it?
Well, first of all, I thought it was quite a good effort. It achieved a lot of things. It sort of pulled a lot of levers in the right direction, and a sort of a piece of technocratic economics. I thought it was pretty well done. However, there are lots of big elephants in the room that we need to address. The first, of course, is that the tax burden is still increasing. So if the aim is to reduce the size of the state, then maybe he made a small step in the right direction yesterday, but the direction of travel is still towards much bigger state than we had before. And with some other underlying problems as well. I mean, the second big problem is the lack of economic growth. The growth forecasts were revised down yesterday. That was partly because the starting point was a bit better than we thought, a big up revision to GDP between 2020 and 2022. But if you look beyond the headlines, per capita GDP growth was basically going to be none at all for a couple of years. The outlook for public spending, I mean, I'm keen on public spending being controlled, but there are actually some quite big cuts in there in real terms, and there are questions about whether that's a credible commitment for this government or maybe for the next one. And then finally, a lot of this is underpinned by very high migration. I mean, without the big increase in net immigration to the UK from abroad that we saw confirmed in the data on Thursday morning, the growth numbers will be even weaker and the public finances potentially even worse. So there's lots of big problems below the surface that a couple of small tax cuts don't really do anything to solve.
Okay, so I want to keen to come back to some of those topics, but before we do that, let's dive into some of what we make of the specific details. So I think the premise of the autumn statement was this good news from the Chancellor, at least in his mind, which is a kind of stronger than expected public finances. He had more room to play with. And I was wondering what you kind of, if you can explain that concept to us. Why is there suddenly more money than the Chancellor thought he might have otherwise had?
Okay, well, the single most important reason why there's more money for the Chancellor to play with is inflation has been higher than anticipated. And ironically, inflation is actually quite good for the public finances. I mean, there are some downsides. It means that spending on certain types of benefits are higher, and debt interest payments are higher as well. But it also raises a lot more revenue for the Chancellor because incomes, prices, and in particular wages are higher than the OBR had been anticipating. And in particular, that's raking in a lot of money through something called fiscal drag. Now, this is because the Chancellor and his predecessor in the job, Rishi Sunak, decided to freeze the personal allowances, the thresholds at which you start paying income and also national insurance So the government is getting in a lot more money from the fact that people are earning more in cash terms than the OBR have been anticipating. So what he's done is to give some of that back, not all of it, but some of it. So
it's kind of interesting here. So he's got this larger than expected revenue inflow, and then he's basically giving that back in a few different ways. So the first way, which is something that a lot of economists are welcoming, is this introduction of permanent full expensing. Now that's apparently, according to the government, got a 9 or 10 billion pounds a year cost to the Treasury, although I think that's in the short run. In the longer run, it doesn't cost as much. I wonder if you can explain what is permanent full expensing, and what kind of impact could that have?
Okay, well, full expensing is basically a policy that allows companies to offset certain types of investment, not all types of investment, but certain types of investment against tax, particularly investment in plant and machinery. And it's a policy that many people have been advocating for years. I think pretty much every free market think tank at some point has signed up to it, but it's something that's accepted widely across the political spectrum as a good thing to do. The policy was initially introduced only on a temporary basis for 3 years, if I recall correctly. Which was better than nothing, but does create problems, because what it meant was that a lot of companies were sort of rushing investment. So it's bringing forward investment, but not encouraging them to do things permanently. And also it might have meant that some marginal projects are actually being undertaken that probably shouldn't be done at all. It's much better to make it a permanent regime, which is what he's finally decided to do now. But this is also a good example of him only giving back part of what he's taken away, because of course, he's also, a year ago, raised the main rate of corporation tax from 19% to 25%. And that's a far bigger tax increase than the tax cut he's announced with making full expensing permanent. So this is another good example of, yes, it's one of the biggest cuts in corporation tax we've ever seen, but it follows an even bigger increase. So overall, business community is still worse off, and investment is still likely to be lower than it would otherwise have been.
So the interesting thing I'm finding about full expensing is that it is a lot of groups are kind of declaring mission accomplished, but there is a little bit further that can be gone. You made that point there. That doesn't actually apply to every single type of investment, and it will mean they can immediately run off. Sometimes doesn't. Are you ever going to think of what is not covered by it, and potentially would you make an argument that in the longer run it should be that you should treat any kind of investment, be it buying a computer or building a big factory, as an immediate write-off to your tax, rather than having to do it over a longer period of time and a cost being associated with that?
Yeah, I mean, that is part of the problem with any of these sort of tax breaks. Unless you apply them to all types of investment, then there's quite a bit sort of dead weight of distortions on top of
Bias.
that. It helps some companies to invest, or directs investment into one type of activity rather than another, which isn't a good thing. My own preference, by the way, would be actually simply to have not raised corporation tax in the first place and keep it really, really simple. So you just have a lower rate of corporation tax rather than a complicated system of investment allowances on top of that. But if you are going to have these tax breaks specifically investment, I think they should apply to all sorts of investment, not just particular types of plant and machinery, as we're seeing at the moment. And the good news is that the Chancellor has actually announced a consultation on those allowances, and it might be that there's something that he'll look at again at some point, is to get rid of some of those allowances to broaden the scope of the tax break. Which obviously would cost more money in the short term, but as you hinted, actually in the longer term, the costs of these measures is far less, partly because they replace an existing set of capital allowances, but also because the investment itself boosts the economy, boosts jobs, boosts incomes, and raises more tax in other ways.
So going back to what is a bit more retail politics, which is the Chancellor's rabbit out of the hat, which is not the 1p reduction in national insurance, the 2p reduction in national insurance. Now, I think there's a certain irony here that Rishi Sunak, when he was Chancellor, tried to put up with the health and social care levy, national insurance by, was it 1.25% on both sides. Then that got withdrawn under the short-lived trust regime, and now and never brought back, and now it's going down even further. I'm wondering what you make of that as a tax policy?
Well, first of all, you've actually touched on a very important point, which is that the tax burden isn't just about the level of tax, it's also about the complexity and the uncertainty around those taxes. So the national insurance has been up, down, as have various types of business taxes over the last few years. And the politicians making promises on one tax that they then break, or constrains their ability to do other things. So there's an awful lot of uncertainty about fiscal policy and tax in particular at the moment, which is very unhelpful, particularly for businesses, given the uncertainty that creates for their decisions. In terms of national insurance specifically, I think it did make sense to cut national insurance rather than income tax. That's partly because national insurance, by and large, is a tax paid by workers, so it's better targeted at making work pay, whereas income tax is levied on other forms of income. It's also because it's a bit better targeted, a 1p or a 2p cut on income tax on national insurance actually costs a little bit less than an equivalent cut on income tax. So wearing my old hat as a Treasury official, I would slightly prefer to cut national insurance than income tax.
And of course, ideally here, you'd abolish national insurance altogether and combine it into income tax system. It doesn't really make sense to tax labor separately, depending on what age you are, when it's not in any way connected. It's not national insurance, it's just a tax. There's no pot of money that's being created by national insurance. If you tried to sell an insurance product called national insurance, you'd have deceptive conduct issues with the CMA, I suspect.
I mean, it's also really messy. He did actually make one small improvement this week, which is he got rid of one class of national insurance altogether, a sort of a lump sum charge every single week that self-employed people have to pay. So we now have a slightly simpler national insurance system, but it's still pretty complicated. It applies a different rate to different types of income, and in some cases older people can avoid it completely. So it's a messy tax, and in line with the general principle of keeping things simple, yes, I would agree with the longer term objective of simply merging national insurance and income tax. I guess one reason why people are reluctant to do that is that it would mean that the new rate of tax, whatever it would have to be higher than the existing tax. So even though all you're doing is combining two taxes, inevitably it will be seen by some people as a sort of stealth tax or a new.
Yeah, I mean, it would have distributional consequences as well, because it would mean lower taxes for workers, potentially higher taxes for retirees who have other forms of income coming in. I'm interested, just moving on though, to the government's kind of other key theme of the budget, which is this around welfare and work. So there've been several announcements around trying to strengthen work capability tests, try and get people off welfare, which is a huge increasing fiscal burden, as well as you could argue a social burden, that you've got millions more people out of the workforce or unemployed in the post-COVID world. And also at the same time, the government putting up the benefits in line with inflation was 6.5%. I'm wondering what you make of this effort of get back to work as a theme.
I think it's absolutely essential. One of the ways that the UK economy has performed particularly poorly over the last few years is that lots of people have basically dropped out of the labour force during COVID and haven't returned for a number of reasons. But part of it is simply about the incentive to work not being strong enough. Now you can tackle that in a number of ways. One is to make work itself more attractive, and you can do that, for example, by cutting the tax on employment income to make sure that people take home more of the money than they would otherwise have done. That is part of the justification for raising the national minimum wage, though I do have concerns there that the recent increase may be just a little bit too big and stretching the limits too far what businesses can afford. So it's partly about a sort of a carrot, if you like, to make work more attractive. But I think also sometimes it has to be about the stick. And there's been an extraordinary increase in the number of people who are on benefits and not working for one reason or another. But disability is an important part of that, including, unfortunately, an increase in the number of people with mental health problems. But one of the sort of silver linings of the big change in the labour market post-COVID is the increase in the number of people who are now working from home or can work from home. And that might be an opportunity for many people who are disabled and perhaps not able to go into an office or work in the way that used to be traditional to actually start to work again. So there are incentives now in place to do that. And on top of that, there are inevitably always some people in the labour market who, would simply rather take a benefit check from the government rather than work. So a little further tightening of the sanctions regime there, I think, is something that's quite reasonable.
So you've briefly mentioned there, but I'm interested in unpacking this point about the minimum wage, which has probably gotten less attention than it deserves. So, I mean, of course, the minimum wage is a relatively new phenomenon in the UK. It was only introduced in 1997 by the Blair government. And I think it was a bit of an intention at the time to keep the minimum wage at a level that was pretty much affordable by businesses, but also something that was balanced with the need to ensure that you don't have excessively low pay. And that was the low pay commission process. The government, of course, flipped on this into what's called the national living wage, which is kind of arbitrarily working towards 60% of median income. Now, the government's gone even further on this and said the national living wage will apply to anyone above 21. And they've also accepted a quite significant increase, almost 10% increase. I wonder what you think the potential risks are of that large jump in the minimum wage. Because I think a lot of people have said, if you try to debate this point with them, they'll say, whoa, we've heard this all before about the minimum wage. It hasn't led to a significant level of unemployment. We heard this in 1997. It didn't happen then. Why was it going to happen now? What is the risk?
Well, I think, the important thing is to acknowledge the trade-offs. And obviously, the large increase in the national minimum wage or living wage will benefit a lot of people. And there's going to be a substantial chunk of people who are actually still going to see their real incomes increase next year, even though many others will be seeing them fall. So it is clearly a boon for those people who are going to receive that wage and remain in their job. But there are various trade-offs here. I mean, one is that I think actually the target is to raise it to 2/3 of median earnings, which is pretty much stretching the limit of what many smaller businesses in particular will be able to afford. So at a point when those smaller businesses are already struggling with other costs, given the global cost of living crisis and rising energy prices and business rates and so on, we might be reaching the point where, with the labour market already starting to turn, then we might start to see some quite significant job losses as a result of the national minimum wage being where it is. The second concern I would have is what this might mean for inflation, or more precisely for monetary policy. Rightly or wrongly, the Bank of England is paranoid about the risk of a wage price spiral. So the fact that the national minimum wage is going up by 10%, and it won't just be people on the national minimum wage who are getting big raises as a result of this. There'll be people just above the national minimum wage who will expect to see the pay differentials maintained. So this will add to the headline wage numbers, and given the Bank of England's concerns about inflation, that might mean that interest rates remain higher for longer. The final point you touched upon this is whether or not it's appropriate to have a lower minimum wage for younger workers. Now, a lot of people struggle with this idea because they say, why should somebody who's contributing the same amount be paid less just because they are 18 or 20 rather than 25? That slightly misses the point, because the thing about the national minimum wage is it's not a ceiling, it's a floor. So if an 18-year-old is genuinely contributing as much as a 25-year-old, then of course the employer will pay them the same. There's no economic incentive to do anything different. The reality, though, is that younger workers do tend to be more expensive to employ because they are, less well trained, or they require more training, they have less experience. So it's always been accepted that it makes sense to have a lower wage for the youngest workers.
Allow people to get onto the employment ladder, climb up, build skills, don't cut off the lower rungs. And I think it's a similar situation as well, where the risk is not only reduction in employment, but also reduction in hours. Also, I think a bit of a risk for lower skilled workers, which tend to be the least productive, and therefore businesses might struggle to pay these higher wages.
Particularly, as you say, particularly if they are the younger workers, because the increase for them, if I recall right, is more than 20% in the national minimum wage. So that makes it now significantly more expensive than it was before to employ a younger person. Now, the saving grace here might still be that the economy is sufficiently strong and there are enough labour shortages that companies will be paying these higher wages anyway. But if that were the case, why do we need the government to intervene and raise them through a national minimum wage system, which applies across the board, rather than simply allowing employers themselves to work out in which areas they can afford to pay people more and do that, and leave wages elsewhere at the existing
So, Julian, and another major announcement in the autumn statement where the government talk about 110 supply side measures. I'm not sure if there's a full list here, but there does seem to be quite a lot of associated documentation about things like pensions regulation reform, speeding up infrastructure delivery, talk about the growth duty on regulators. I wonder what you make of what the government's trying to do on the supply side economy.
Oh, I'm really pleased to see that. Some people have suggested if you've got 110 separate policies, then really you don't have one at all. They're just sort of nibbling away at the margins, not really making any difference. But I would give the government a little bit more credit than that. So, some of the areas in particular that I look at, financial markets and capital markets more generally, I think there's some decent stuff going on there. Planning reform, they seem to be taking that a little bit more seriously again, just little measures to speed the process of planning approvals and reduce some of the sort of the red tape around that as well. So these little things are helpful, but I think even though, despite that, many of us looking at the announcements in the autumn statement will think this is just a rehash of some bits of the Liz Truss quasi-Kwarteng growth plan a year ago, but being implemented much more slowly.
So going back to some of the macro issues you talked about at the start. So obviously we've got this sense of what is specifically announced by the Chancellor on the day, but we also get the Office for Budget Responsibility's latest views on the state of the UK economy. And despite the kind of upbeat tone from the Chancellor, diving into those documents is a pretty horrifying read. You start with the GDP figures. We're expecting 0% growth this year, 7% growth next year. We've got inflation is still expected to remain above target, although that might be overly pessimistic on an inflation front. At the same time, despite the announced cuts in taxes by the government, we're still on track for the highest tax burden in 7 years. The tax burden will continue to go up for the next 5 years. And that's for that reason you mentioned earlier, which is frozen thresholds for the income tax. For every £1 they're giving us in a national insurance cut, they're taking £4 with the other hand through higher income tax. 7 million people are going to be paying a higher threshold of income tax. When you get into these details, it does seem like it's quite a miserable picture from the OBR.
Yes, so there's no criticism there of the OBR. I think they're just reflecting the reality. If you look at independent forecasts, then the numbers for GDP growth are actually slightly lower in many cases than the OBR has been forecasting. So the OBR is just telling it as it is. Excuse me. As it happens, I think there are a couple of reasons to be a bit more optimistic than the OBR. One is, as again you hinted at, I think inflation will fall more quickly than the OBR is anticipating, and indeed than most people are anticipating, and that will allow interest rates to fall a bit sooner as well. So that's several pluses in there for the economy and also for potentially for the public finances too. The second point is about productivity. Now, the OBR has got some quite cautious assumptions about productivity factored into its forecast, which is understandable because the OBR had been expecting productivity to recover and it simply hasn't. But if we can get productivity moving, including, by the way, productivity in the public sector, which has been one of the worst performing areas here of any part of the economy, then there is scope for the economy to grow much more sharply. But that will require a lot more effort, I think, on the supply side reforms. It probably require further well-targeted tax cuts, and actually, in a few cases, a bit more public spending as well. I think we do need to invest in better IT in the public sector to gain all the benefits of artificial intelligence and other potential productivity improvements. And fixing the backlog of work in the NHS probably requires a bit more spending, as well as reforming the processes on top of that as well. So we may have to spend a little bit more in the short term there in order to fix those problems on the supply side in the public sector as well.
Yeah, I mean, it seems to me that we're at this kind of fundamental crossroads here when we're going back to the topic about big government. So a lot of the rhetoric immediately after the Chancellor sat down was, well, taxes are on their way up. And I think the reason for that is also because spending is on its way up and growth is extremely low. So even if you want to cut taxes, you've got to try to find a way to pay for that. You inevitably, you can't just put it on debt. That's just tax delayed sometime into the future. So I feel like we're almost stuck here, aren't we, Julian, where we've got this kind of relatively low growth, relatively high spending, high taxing government. The Tories are overseeing this, and they've overseen a big increase despite their rhetoric and their inclinations, because they're not willing to deal with some of the more structural difficult factors. I mean, some fundamental element came to mind here when the Chancellor said we're going to increase pensions by 8.5%, huge amount, and pensions are going to keep on going up by extraordinary amounts, massive fiscal impact. But also at the same time, you've got huge increases in spending on welfare for the reasons we've discussed. You've got more spending on healthcare as we have an aging population, as well as just the government's decided to put more money into the NHS despite us not getting any kind of better outcomes out of it all. So I feel like we're almost trapped here to put forward a more pessimistic view, where it's very difficult to get out of this situation now that we're in it, because taxes are just going to keep going up and growth is going to be stagnant, and the reforms that won't come.
Yeah, it is a huge problem, and there are no easy answers. I mean, I think there are a few things that do need to be done, but these are difficult decisions which inevitably we're going to have to wait until after the next election, because no government is going to be willing to talk about them, let alone do them now. For example, you mentioned pensions. I think in the longer term, the so-called triple lock on the state pension has to go. It's just going to, otherwise we're going to spend an ever increasing proportion of national income on the state pension, which doesn't make a lot of sense. Health and social care needs fundamental reform. This isn't just about the NHS, and I would say that the NHS would be a lot better if it had more competition, more private finance and private provision. It's also about healthcare, and I'm particularly aware of the pressure of aging in terms of the need for dementia care. At the moment, we have a failed market there. It's impossible to insure against the need to get dementia care in the future in the private market, because it's too expensive to do so. That's maybe something the government could look at trying to help fix in one way or another. So there are a number of things that we can do around pensions and health and social care. The other thing I think to stress is that in the short term, sometimes you do have to recognize the need to borrow a little bit more. Now, I think we've now reached the limits of that. But if you were to say to me that the government is going to have a policy of, broadly speaking, borrowing, say, 3% of GDP per year, so 3% of national income, in order to invest in better public services and infrastructure, and then balance the rest of the budget. So in other words, we have an overall budget deficit of 3 or 4% of GDP. I would be reasonably happy with that, particularly because as long as the economy is growing at 3 to 4%, including the impact of inflation, so that's 2% real, maybe 2% inflation, that's still enough to stabilize the debt to GDP ratio or get it falling. So I think we need to be realistic about how much we can do in terms of balancing the overall budget. As long as borrowing is low and limited to borrowing to invest, then I think we shouldn't obsess too much about what the annual budget deficit is from year to year.
Well, Julian, Jessop, IEA Economics Fellow, thank you so much for joining the IEA podcast. It's been a fascinating and enlightening conversation, as always. If you're enjoying the podcast, please do subscribe on your chosen podcast provider or on the IEA's YouTube channel. Please also, if you want to learn more about the IEA's work and analysis, you can just visit iea.org.uk.